At any point, we will see a correction come in, but key distinction, any correction, in my opinion, all things being equal, is profit taking and not a market sentiment shift from bullish to bearish. Rather, it's an opportunity to grab what you have on the table before it moves lower and then reposition yourself. A lot of the traders and speculators who believe they missed this, okay, I have another opportunity to re-enter. We could see that if it does correct, see it go deeper. I would look at these as opportunities rather than the end of a bull run.
The gold to silver ratio is like 45 now, which is, it's pretty low, but that's only from the last few years. I mean, it can get all the way down to 15 or 20. I wasn't expecting this kind of move in silver until there was another printing round.
Yeah.
And the fact that you could argue that it started because QE started like a month ago and they're printing $40 billion for bills, but this is really just at the bottom of the monetary structure, you could call it. But
right.
there's no mass bailouts yet. There's nothing big really happening, and yet we have this huge move in silver.
Any upcoming market correction should be viewed as tactical profit-taking rather than a fundamental shift from bullish to bearish sentiment. For traders who feel they missed the initial surge, these dips represent a critical second chance to enter the market before the next leg up. With the gold to silver ratio currently hovering around 45, there is still significant downside potential for it to compress toward historical norms of 15 or 20, implying significantly higher silver prices ahead. Gary Wagner, producer of the Gold Forecast, and Rafi Farber, publisher of the Endgame Investor, analyze this unique market strength. What makes the current rally exceptional is that it materialized before mass bailouts or aggressive quantitative easing began. While minor liquidity operations have begun, the absence of a full-scale printing round suggests the move in silver is organic and driven by fundamental structural stress rather than liquidity injections alone. This indicates that when the inevitable bailouts do arrive, the subsequent move could be exponential. Now, we present the clips from Gary Wagner and Rafi Farber's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
The gold to silver ratio is like 45 now, which is, it's pretty low, but that's only from the last few years. I mean, it can get all the way down to 15 or 20. Well, like the calculation in my head is like, well, assuming we're right about everything, assuming that the dollar really is going to collapse and all purchasing power is going to go into gold and silver, what am I supposed to do with that? I don't think we're in the end game until the next printing round begins, until there's another banking crisis, and then the Fed moves from wherever we are. We're still at like 4% interest rates. What's the Fed funds rate now? I don't even remember.
I think it's around 4%.
So it's around 4%. When they go back to 0 and then they print $5 trillion in a week, then we'll be in the end game. And then what we're seeing now will be like a nice breeze on a warm day.
Yeah.
Okay, so 115, 100, where are we now? So we're somewhere between 110 and 120. I don't know. I mean, because I haven't looked in the past 5 minutes. So you could be anywhere. But there's really nothing big going on in the world right now other than precious metals are moving. But when precious metals are moving, that means that everything else is going down in terms of money. Because what a lot of silver stackers and gold stackers still don't understand is that this isn't about increasing dollar holdings with a metal. It's about the dollar going down entirely and then everything being denominated in terms of that metal that you stack. Right. And that's not gonna work for ETF hoarders or for any other kind of gold or silver derivative. And not that I'm against buying silver derivatives or anything like that. I own silver derivatives, but this is what do you call it? Separating the men from the boys, or what would be the equivalent of separating the stackers from the investors. I mean, those who invest in gold and silver and those who are divesting with gold and silver. And this sounds like an academic point, but it's not really an academic point, because the end game is coming. There's going to be a point where the dollar's not going to work at all. Mm-hmm. And when it does, the silver derivatives are not going to work at all either. You're not going to be able to get anything with them. And we're going to be in the end game. Now, the question is that now or is it later? I still think it's later. I still think we have a little bit of time before the end comes. But the end's going to come. And when it does, I don't see the other ones turning around so much. The ones who believe that okay, they like silver, they like gold, but they think it's in a bubble now, and there's going to be a correction. I'm not saying there isn't going to be a correction. There's going to be a correction, but what I'm saying is that after the final correction, that's going to be it.
Right.
Right. I can see it. I can see it coming up. I can see there's going to be a banking crisis, and then all those industrial interests that are buying silver now for $110, $115, $120, they're going to have a lot of extra silver that they're buying now out of some kind of panic because they think it's not going to be available, which is why they're buying it now. And then they're going to have their debts to pay, which are still dollar denominated. They're going to have to sell some of their silver for dollars in a dollar crunch to pay that debt. And silver's going to go down.
Yeah.
The thing is, there are three questions I can't answer. When is it going to start to go down? From where is it going to start to go down? And to where is it going to start to go down? I don't have any clue.
Yeah, no, totally agree.
Way too volatile.
Certainly those who've been accumulating and stocking up on physical gold, physical silver, they're in good profit. So a swing a little bit to the downside doesn't really affect them either way. I would think they would need more downside to accumulate more, because we are looking at these metals at all-time record highs. And when you get that, I think it was Paul Ben Bernanke, and he was saying this in regards to interest rates, but I think it's applicable to gold and silver. He said trees don't grow to the sky. They never have. They never will. In other words, there are going to be absolute tops or price points in which it's gone from an extremely overbought scenario to when they're acting on it. We saw a little bit of that today, but what is remarkable to me is that even though they, for example, with gold, they took it to 57.90. It's at 5,044. Even when they moved the needle and moved it down, the low that came in was just right above 5,000, about $5,006, and they bought that dip up quickly. So anytime we're seeing profit taking come in, and we haven't seen much of it, we did see it today, but as it came in, what was interesting is how quickly it moved off of those lows. There was that point at around 5,100, at around 5,000, where traders said, you know what, this is an opportunity to enter, not the point to sell it or to fade these markets. To me, shorting gold or silver right now, and that at some point won't be a truthful statement, but for right now, to me, it's like standing on a train track and the train's coming right towards you and you want to play chicken with it. I don't think that that's the wisest way to play the metals right now. I think that you're just going to get crushed. There will be a point, as I said, trees don't grow to the sky. There will be an absolute top. There will be inevitably a correction, but the key is the fundamentals that have moved this market higher, and especially the uncertainty factor of our administration, in which our administration tends to change attitudes and policies at different times. And so nobody's certain that there's going to be that stability that we want in terms of policies being enacted and maintaining that. Right now, I remain extremely bullish on both gold and silver. I have the caveat, though, at any moment, we can see it come down and actually enter a correction. And it doesn't necessarily have to be driven by a fundamental event. Fundamental events are what's moved the metals higher. Absolutely. This is not a technical move as we see it climb to the upside strategically. Silver over 100. Gold trading over 5,000. This is based on hardcore fundamentals. But the technicals will come and play as points of profit taking. But if the fundamentals remain the same, which I believe, at least for now, they are, those dips will get bought up. And that's what we saw this morning. Silver take off over the last couple of days in a much more aggressive manner in terms of price gains. But gold is very, very strong. Rather than say, do I want this or this, allocate a portion to silver, a portion to gold. When gold's running hot, which it did, you might want to have, 60, 70% in gold and 30% in silver. When silver's running hot, you might want to reverse the percentages. But I don't believe the most prudent move is to move all of the assets from gold to silver or silver to gold, but rather work with the ratio and maintain both of them because they're both moving aggressively higher. And it's much harder to determine whether it's going to be silver or gold that make major moves. Typically on the way up, silver typically outperforms gold in terms of percentage gains. On the way down, though, silver typically outperforms gold in terms of percentage drawdown. It's just a more volatile metal than gold. And so caution should be the underlying tone whenever you're working with silver on a short-term basis. Long-term basis, it's different because I believe that 100 should be a benchmark that holds the support in silver now. And that would be something I would probably or might not have said at the end of last year. But the facts speak for themselves. Since the beginning of this year, when we look at silver's gone from about 70 to 100.
Current market dynamics are separating those who hold metal to divest from a dying currency from those merely seeking dollar profits. While the gold to silver ratio at 45 signals significantly more room for silver to run, potentially compressing to 15, the actual endgame will only commence when the next banking crisis forces the Federal Reserve to print trillions and slash rates to zero. In this environment, paper derivatives pose a catastrophic risk as they will likely fail precisely when the dollar collapses. Strategies must shift from trading to survival. Although short-term corrections are inevitable as industrial users liquidate holdings to service dollar debts, these dips are being bought with ferocity, confirming that shorting this market is akin to playing chicken with an oncoming train. With silver establishing $100 as a new hard floor, the prudent strategy is not to trade the volatility, but to maintain physical exposure to both metals before the final currency reset renders paper instruments worthless. Let's get back to the interview.
The uncertainty factor and the geopolitical risks involved are going to favor gold and continue to favor gold. By virtue, it's going to support all the precious metals, including platinum and palladium. I typically don't look at those markets as strongly, simply because in terms of futures trading, there's less liquidity. In terms of physical possession, I think that there's still more upside potential in gold than platinum, and silver than platinum. So you can make those plays to diversify, but I haven't been a huge huge advocate of moving gold holdings into platinum, for example. It just hasn't shown me that. Now, as you said, it's catching up and it's starting to move, but I think that is a kind of unison trade. It's moving because of gold, which is leading the way in all precious metal. Anytime we should or will see a correction in the market. Gold actually has just turned negative at $5,004. At any point, we will see a correction come in, but the key distinction, any correction, in my opinion, all things being equal, is profit taking and not a market sentiment shift from bullish to bearish. Rather, it's an opportunity to grab what you have on the table before it moves lower and then reposition yourself. We might have some sort of a correction in between the point where it sells lower. That's an opportunity to buy the dip. I believe the smart traders will believe that, whether we're right or wrong. We could be right or wrong, and we don't know until proven that way if it does start to sell off. But what I found is that every time gold and silver have challenged these lows today, they've popped back up. So we'll have to see if it can continue to do that, or if what we're looking at is the beginning of around a profit take. It would be a correction, but I think it would be shallow at best. As I said, $90 in silver. And in terms of gold, I would have to say maybe 4,800, 47.75 in gold. And that at some point we're going to see a lot of the traders and speculators who believe they missed this. Okay, I have another opportunity to re-enter. We could see that if it does correct, see it go deeper, but I would look at these as opportunities rather than the end of a bull run.
I wasn't expecting this kind of move in silver until there was another printing round.
Yeah.
And the fact that, okay, you could argue that it started because QE started like a month ago and they're printing $40 billion for bills, but this is really just at the bottom of the monetary structure, you could call it. But
right.
There's no mass bailouts yet. There's nothing big really happening, and yet we have this huge move in silver. In 1980, there was the price inflation, or consumer prices were rising at like a 10 to 15% clip. And now, and you could say that the CPI isn't on as fine, but it's not at 10 or 15% like it was in 1980. We're not there. We're not in any kind of hyperinflationary moment here. We're in a sort of purgatory where people are starting to realize that, yeah, the dollar is not really going to last so much.
Right.
But there's no lines at supermarkets hoarding food or hardware stores, or there's no flight to real goods yet. So I wasn't expecting this kind of move until that happens. So what's concerning me, I would say, is that if this is happening now, when nothing really big is happening, what's going to happen when something big really is happening? Silver in the COMEX, I haven't checked the number recently. I'm guessing it's like 400 million ounces, right? And that's still a record high. It's still almost a record high. The record high was like a 500 million, 500 million, but that was only a recent record high. And in London, there isn't much. And in Shanghai, there's even less. But Shanghai, that's where most of the manufacturing is, right? That's where the trade deficits come from. So most of the silver manufacturing, where they would need silver to actually put in their capital machines to create whatever they're creating, that's happening in China. And so they would be the ones to withdraw that silver from their exchanges, and to make sure that they have it, they would pay a premium, and I'm not even sure how much. It depends what you're manufacturing, or what percentage of cost with the silver and whatever you're manufacturing, and how high would you be willing to pay for it.
Right.
So there's a big disconnect now in the American market, where silver, the refining, that's the word I want.
Oh, refining.
The silver refiners, they're in a backlog, so that would dampen the demand for coins, because they can't take the coins and melt them down because there's so much that they still have to process. Whereas in China, there's demand to just keep stock available to keep the manufacturing going. There's really like 3 different markets in silver right now, and they're really starting to split apart. That's indicative of a dying market.
Geopolitical instability has locked gold in as the ultimate haven, forcing platinum and palladium to follow in a unison trade driven by fear rather than industrial utility alone. Market analysis suggests that any pullback, potentially to $4,800 in gold, should be viewed as a shallow profit-taking opportunity rather than a bearish reversal. We are currently in a monetary purgatory, a dangerous interim period where the dollar is structurally failing, yet mass hyperinflationary panic has not yet arrived. A critical fracture is emerging as the silver market splits into disconnected realities. U.S. refiners are backlogged and unable to process retail scrap, while Shanghai drains physical inventory to keep factories running. This fragmentation acts as a dying market signal, proving that physical scarcity in the East is beginning to break the unified global price mechanism. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support us by turning on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.